Well, welcome everyone. We're on week 6, and tonight we'll be going over chapters 7 and 8. So chapter 7 is on risk analysis, and as part of that, we'll be covering the following educational objectives. So the basic stuff: describe risk analysis and its importance, explain how probability analysis can be used to estimate the likelihood and consequences of an event, and then be able to describe some of the characteristics of probability distributions. So for those that didn't like stats in college, well, we get to do a little bit of that, but it's just the basic stuff. So expected value or mean, standard deviation, coefficient of variation, and normal distribution. Also need to explain how organizations use regression analysis to forecast gains or losses. And then we'll talk a little bit about decision tree and event tree analysis in terms of the methods that they use to evaluate consequences. And really, when they use the word compare the two, really talking about advantages, disadvantages, and there's actually a good figure in there that will help you study for that. And then finally, explain how to analyze loss exposures considering the 4 dimensions of loss and data credibility. So risk analysis, or this chapter, is typically in the past has been the chapter that most people struggled with because of the math on it, or the stats, but they no longer really require doing the calculations. If they do, it's really simple. And you'll see that as if you've read this chapter already, kind of the simple math and some of the numbers that go with it. So if anything else, you're gonna have to describe what's going on when they talk about expected value or mean, skewness, standard deviation, and be able to understand what those characteristics would mean in terms of losses when you do a risk analysis or loss analysis. So let's get into it. So intro to risk analysis. So what the goal is when we do that, why we're doing that, is for the organization to understand the risks it faces before it can decide how to treat them. So if you remember what we started with, you want to identify the risk, you're going to analyze the risk, and then the next step we'll be looking at is actually treating the risk as it talks about there. So when we do the risk analysis, part of the whole idea is we need data, right? We need information to be able to make decisions. And if you think about what we talked about in chapter 1 and 2, is really what enterprise risk and risk management is about nowadays. It's about making decisions. It's about having the information to make decisions that will help the organization achieve its objectives. So what does risk analysis do for us? It provides information for understanding risks and making decisions regarding treatment, right? How we're going to treat is, right, what we're going to implement, the mitigations. And also the sources and consequences of identified risks are considered. So we can start thinking about, what if we do this, what are the potential consequences of these type of events? The likelihood of each consequence, as well as the effectiveness of controls. And also when we do analysis, it will help us determine the level of risk. And a lot of this is done when we think about analysis, and at least for this chapter, it's really looking almost like regression analysis. It's a lot of the things that actuaries would do in trying to look at what's the probability of failure or a bad event occurring. And so that's really a lot of this is looking at probably back to the hazard analysis aspect, but these same type of techniques can be used for reputational risk, operational risk, failure of pieces of equipment, which will also be operational risk as well. So you'll kind of see that, and hopefully I can help tie that up for you a little bit to help you understand a little bit better. So nature of risk analysis can be used to analyze events, product lines, projects, or processes. So while we might look at events or hazard events, that can be part of it. But again, product lines, failure of or quality control type issues, all those things use stats and QC. When we talk about quality control, that this is all part of that analysis. And as we do that, the goal is to identify how risk would affect the ability to accomplish our objectives, right? Whether it be making sure we don't have defective products, that would be one of the objectives. Helps identify over-controlled and poorly controlled risks, and can identify risks that may have chain reaction or affect other systems. So we talk about over-controlled and poorly controlled risks, right? If we identify that we might be doing a really good job with all of our efforts on, let's say, earthquakes, right? We have buildings, we know earthquakes are a risk in California, we've done the seismic bracing, but there's only so much more we can do where we're not going to have that marginal rate of return, right? And so that's the idea of over control. but you can also identify poorly controlled of if we continue to have, let's say, auto accidents, right? If we have a fleet operation, and we continue, we implement maybe driver training, and maybe that helps a little bit. And then we implement, let's say, a product like a drive cam or webcam that helps monitor driver performance. That might also help. And then, so all these things over a period of time, you're going to get the data to see, did that treatment work, and how effective it was. And then, as well as we talk about chain reaction, a lot of times, again, from the insurance standpoint, we think of each of the risks in a silo. Workers' comp, property, liability, each one kind of has its own insurance. But the reality is, in many cases, that one event will have a chain reaction with another type of risk. So if we have a fire in a building, yes, we'll have a property loss, but we may also have a general liability loss, the visitors that are in the building, as well as workers' comp. So all those things can tie together when we talk about a chain reaction or other systems. So the types of assessments and analysis, you can have a qualitative assessment and quantitative analysis. So qualitative assessment will measure risk by significance of consequences. It is typically somewhat subjective when we talk about qualitative. Again, qualitative being qualities. And a lot of risk assessments and some of the tools that are out there, and if you take a look at the University of California UCOP ERM program, if you do a Google search for that, there's lots of risk assessment tools. And what you'll find on there is that you'll assess some risk by high, medium, and low, or maybe some type of severity thing. And it's getting a group of people together to actually kind of talk about some of these risks. And so it is going to be somewhat subjective when we talk about a qualitative assessment. When we do a quantitative analysis, we're going to have a specific values to the consequences and their probabilities. And when we do a quantitative analysis, one of the things we'll talk about later in the chapter, we have to have reliable, credible, consistent historical data to be useful. Right? If we only have 1 year's worth of data, we're probably not going to be able to do a whole lot with it. So the more data that we have, that we know it's coming from a credible source, right? That the coding is good, it's consistent in how the coding is applied. We're going to be able to do something with that data. We're going to have much better quantitative analysis with that. But the reality is both approaches use estimates of probability to assess risk, right? So whether we say high, medium, or low, or we have data to help us do that quantitative analysis, there's going to be some estimates of a probability, and you're going to see that as we go through this chapter. The other aspect is how we're going to assess controls, right? The analysis should also include an evaluation of the effectiveness of current risk control measures and the potential impact of new controls. Now, being a safety professional, one of the challenges that we always have had is how do we assess whether what we're doing is working, especially, let's say, from a workers' comp perspective. Because we're using lagging indicators, we're using probably the number of injuries or things like that. It's a little bit more challenging to say whether the controls are working. And also because risk managers typically will get their numbers from the actuary, and their data is a little bit different than what we might be using in how we measure our exposure base. So as an example, this is kind of off the little sidebar. No, but I think it's important for those, whether you're on the more familiar with the risk management side or you're familiar with the safety side. For those on the risk side, for actuaries, they typically use payroll as their exposure base. They're typically not using hours. And also what they tend to do is they'll use the last 4 years of data, excluding the most recent year. The reason why they exclude the most recent year is because it's too green. It hasn't matured. There's not enough loss development in it. And so when they provide numbers to leadership, typically those numbers are very much lagging. Like I said, they're about 4 years out. Well, on the safety side, we typically use hours, which is, I think, a little bit more measures true exposure than payroll, because depending on what people get paid, things like that, right? And we do it year by year, right? And so we get the most recent data. Now, we may not have the cost aspect because that's a little green, but we can have a better idea of what's going on. So we're not lagging as much, whereas the risk side is more averaging over a 3-year period, whereas we're really seeing year to year events. So anyways, just that little side note there. So probability analysis. so as we go through this chapter, one thing we're going to be talking a lot about, and you'll be asked about, is the probability analysis aspect, right? So probability analysis is used to estimate likelihood and consequences of a series of events. So when we talk about likelihood, again, depending on risk versus safety, we're really talking about frequency. When we talk about consequences, we're talking about the severity or the cost. So likelihood is the count, consequences is the severity. And the probability related concepts that we also have to understand, and you'll have questions about this most likely on the exam, is be able to explain theoretical probability versus empirical probability, as well as the law of large numbers and what that means from a data analysis standpoint. So theoretical probability. So that's the probability that is based on theoretical principles rather than actual experience. So the examples they provide: flipping a coin, rolling a die, picking a card, right? We know a coin has two sides. We know that there's a 50% probability, rolling die, 1 out of 6, all those type of things, because it's theoretical. We can get an idea of what it should be. Now, empirical probability is actually doing, flipping the die or a coin 100 times, or rolling the die, 100 times, and coming up and seeing if those numbers match that theoretical probability. They come pretty close. Obviously, and then that's where the law of large numbers comes in. And if we're to do it 1,000,000 times, most likely it's going to probably come pretty close to that theoretical probability. All right. So back to the definition. So empirical probability, a probability measure that is based on actual experience or historical data, or from the observation of facts. Must be estimated using a sample or historical data. It only estimates, right? It's not, even though we are going to be rolling a die based on historical, it's still going to be an estimate. And the accuracy depends on the size and credibility of the sample, right? And I mentioned the size, that goes back to the law of large numbers. So the law of large numbers, a technique for forecasting events such as accidental business losses on the assumption that they're governed by an unchanging probability distribution, right? The one question that you'll probably get when it talks about the law of large numbers is some of the limitations, right? And it can be used, as on the point below, to more accurately forecast future events only when the events being forecast meet all 3 of these criteria. And again, from a testing standpoint, whenever they say, these 3 things, or these are the 4 criteria, 3 criteria, that's usually a good indication that it's going to be on the exam, and they'll have a question to say all these things are part of the criteria except for, or something like that. All right, so the 3 criteria: the events have occurred in the past under substantially identical conditions and have resulted from unchanging basic causal forces. The events can be expected to occur in the future under the same unchanging conditions, and the events have been and will continue to be both independent of one another and sufficiently numerous. Now, an example I would give when we talk about unchanging events, and this goes back to predicting losses, right? What actuaries do is how they determine rates is they assume that things are going to continue the way they have been, nothing's going to change, and as you increase your payroll, you're going to have more injuries, right? Well, if you introduce, let's say for slip and falls, a slip-resistant shoe, that can change some of the loss data, and eventually they can see, hopefully if you start seeing a change in that something did change, and then over a period of time, as you get more data, it'll be more credible to say, yes, this was most likely the cause of the reduction in the slip and falls was because of the introduction of the slip-resistant shoe. So probability distributions, and a lot of these are really kind of definitions, but it's important in this chapter. This is very definition heavy as we go through it. So probability distribution, it's a presentation that can be either a table, chart, graph of probability estimates of a particular set of circumstances and of the probability of each possible outcome, right? So a lot of words basically to say a probability distribution can be done in a table, chart, and graph, and we'll see some of those different ways to display that data here in a moment. And then properly construct distribution always contains outcomes that are both, and this is the other important part, mutually exclusive. So one outcome does not affect the other, and they're collectively exhaustive, that the sum of outcomes is 1, right? And so there's typically a question on the exam about different outcomes, and it's the answers are like 1.2 and negative something. Well, the reality is, it can't be 1.2. You can automatically eliminate that because the sum of all outcomes has to be 1. right? It can't be greater than that. So this is just an example of a probability distribution. They just want to give you some ideas of what this can look like. And again, what they're really just trying to show in this, by showing this distribution, is here's the probabilities, and if you add them all up, they equal 1, right? So the chance, again, 0 hurricanes making landfall, it's about a 30% chance. 35, you're gonna have 1, and as you can see, the possibility of having 5 is pretty remote, or 4 or 5 is pretty remote. This is the same type of data, same type of thing. They just want to show, again, this is a probability distribution, just showing it into a different format. So this is something I add in, and this is probably more when there was more math on the exam, but I think it's important just to talk a little bit about discrete and continuous distribution in here. So we talked about a discrete distribution. Each possible answer is defined, right? So and we talked about that as a deck of cards or rolling of dice. We know that it's either 1 out of 52, 1 out of 6 on a dice. We pretty much know that. A continuous distribution it can be always changing, right? So how many injuries did you have on, in this case, August 1st compared to September 1st, or the next day? Things continually change based upon the information. It's not going to be a set number. But either way, when we talk about losses and we do probability, the probability of loss or not having a loss is always going to equal 1. So continuous distributions, how they're often used is with dollar amounts, so claims data payout. But when we do a continuous distribution, and we'll see this as we go through this chapter, is it needs to be put in bins or ranges, right? If we were to try to say, we have a loss that's worth $325, another one $625, and you can go all the way through the line, trying to pinpoint, we're never going to have a match. And so that's why from 0 to 1,000, 1,001 to 2,500 or whatever, that's how we can actually develop like a histogram to actually have a much better visual representation, of that data. Discrete distributions usually displayed in a table lists all possible outcomes and probability of each outcome. And it's used to analyze how often an event will occur as a frequency distribution. So we'll see some of the examples here. So in the case of what they're doing with this is just estimated probability distribution of an investment's gains or losses. And all it's really just showing is, the idea that we'll have 0 to a negative 10,000, 18% probability, but the likelihood of investment gains, let me see, I haven't added the numbers up here, but most likely it's saying 40, 50, 60, about a 70% chance we're going to, have a gain, whereas we're having about a little bit over about 35% chance of a loss. So again, really what they're showing in these graphs in the textbook is just examples of how you can look at data and what it will look like when we talk about various distributions. And so this would be a continuous distribution as a way to display the information, and also displays it as a graph as well. Continuous distributions. Again, just kind of how they're showing figure A and figure B. And it talks about, for example, in the discrete frequency distribution, the probability of a high-rise office building not having a fire, 0 fires might be 50%, or having 1 fire, about 35%, and having 2 fires, 0.15. And this is on page, I think I did the update on 7110 on here. And then it also just looks at it from a sign and a probability, right? You can display it 2 different ways on this various figure. And then it talks about if the disparity distribution is divided into finite numbers of bins, 0 to a million, million to 2 million, things like that. It's just a way you want to display the information of how you want it to look on a graph. Again, from a testing standpoint, I wouldn't expect any questions like this, other than if they're focusing on it, it's really the difference between a continuous probability distribution compared to a discrete. Some of the other characteristics of probability distributions that you'll want to know. So central tendency. and be able to understand what that is. That the single outcome that is most representative of all possible outcomes included within a probability distribution. So we talk about central tendency, the mean, which would be the average, right, that we're used to looking at. The median, which would be the midpoint of a sequential set of values for an even set. Then you have the two middle values. The mode is the most frequent in the set of values. And then we'll talk a little bit about skewness, a measure of whether probability distribution is symmetrical. So when we talk about central tendency, we're usually looking at the mean, median, and mode really all being aligned into one, and you'll see that in some of the charts here. And then dispersion, the variation among the values of a distribution, right? Meaning the mean, median, mode are kind of all over the place when we look at some of the data. So again, this is, I think they add a little bit extra information of how you might look at it from a graph standpoint. And by the way, there is an error in this, and I'll show you that here in a moment. But so the expected value is the weighted average of all possible outcomes of a probability distribution. It's calculated as the sum of the outcome of X probabilities. And so why we think of the average, when we talk about what's expected, and this is usually a term used in actuarial studies of saying, based upon confidence level. Well, the expected value, when we look at that, as it talks about, it's the weighted average of all possible outcomes. And so what they've basically done is there's two, so possibly rolling a 2, it's 1 out of 36, right? Because it's a, 2 dice, it's a 1 and a 1, right? And so we get a 2 over 36. And then the cumulative probability of sum of this probability is 1 out of 36. So the chance that we're going to have this probability is 1 out of 36. And you basically go through and you add them up. There's 2 out of 36 probability, then 1 plus the 2, and that's where this is coming to 3 over 36. And if you add up all the probabilities, we get to 100%, right? It's going to equal 1, like what we talked about before. What this is also looking at when we talk about what the expected value is 2, the 2 over 36 and then 2 times this is 6 over 36. If you add up all these, the cumulative number, it's 252 divided by 36, which equals 7. Well, we of course know that from playing craps that 7 is the most common number that you most likely would have. So when we talk about, the expected value, 7 is the expected value based upon, again, this is the highest, this is the most likely number. 47, we see that that's going to occur the most, as well as when we add them all up, we're also going to get that same number based upon the average of all the possible outcomes. I mentioned, so expected value is 7, the median is 7, and the mode is 7. The mode is 7, most frequent outcome. The median, there's equal number of outcomes, and this is where the error is. It says 15 above and below. It's 5 above and below. So this becomes the median, and the expected value is also that. So that's how, basically, when we talk about central tendency and expected value, that's how all these things come together, and that's what they're trying to illustrate in the textbook. Standard deviation and coefficient of variation, right? So there usually will be a question, the difference between standard deviation and coefficient of variation. So you do want to make sure you understand this aspect of this problem here. So first, standard deviation, it's the measure of dispersion between the values in a distribution and the expected value, or the mean, of that distribution calculated by taking the square root of the variance. Right, now, you used to have to do the calculations on this. You're not going to have to, but we'll show with the standard deviation what that means and why it's important. And the coefficient of variation is the measure of dispersion calculated by dividing the distribution standard deviation by its mean. Right, so that's how you actually get those calculations. I'm going to actually skip this because you're not going to actually have to do this anymore, which is the good news. So why is this important, right? So this is on page 7.15, the example that's provided in here. And they actually talk about, in this case, it's the number of hours for an element of failure, right? So our expected value is that about 5,000 hours, this is our expected value that we will see a failure of the part, or it'll last at least 5,000 hours, and it's not going to last longer, right? So on average, we're going to see that. We might see some go as far as 5,900 hours, and the shortest time that we typically see is about 4,100 hours. Now, why is this important when we talk about a standard deviation, right? So the standard deviation on this side is about, looks like it's 300 from either side. And the standard deviation, what it shows on here is about 68% of the area that's covered is within this one standard deviation, meaning that if we were to say our preventive maintenance of when we were going to take these things out of service so that they don't fail, we're not too worried about the length here, right? Most, if they last longer, that's great. We're really concerned about the failure. And so we'd say, something, we want to prevent the failure. In this case, actually, I need to, if you look at this number, we don't really want to, the 4,700 hours, that's a good number, right, of where we might want to start looking. But really, we want to have as little failure as possible. So if you look down here, 4,100 hours, what does this mean? This is 3 standard deviations. And what this is telling us, if you look at the numbers, that if 99, this whole graph takes up 99%, 0.74. So that means what's on this fringe, right on this other side, oops, hit the button there. What's on this side over here is about 0.05%, right? So our failure rate of this element, if we start changing these out at 4,100 hours, it's about 0.05% will still fail prior to that 4,100 hours, which is pretty good. So the question you might get on the exam, though, is more about standard deviation and how this is applied. And it's really important to understand the 68, 95, and 99. And of course, they give a little more of the percentages here, but to understand that if you have 68%, what's on the outer, what's on the other side of this, just this half, right? So 13, 14, 15, basically about 16%, right? It's going to be on this side, and 16, you get 32, and that's what it's going to equal. But you're really concerned about what's on the failure side more than you are about just splitting it up. And so that's the main takeaway that you want to get on standard deviation, at least as far as from a failure standpoint. And then here's the numbers I mentioned: expected value, the weighted average, central tendency, the single value that best represents all possible outcomes. That's the cluster. That's where we see the mean, median, and mode all together. The probability distribution has a symmetrical variability. So when we talk about normal distribution, if it has a normal distribution, which in most cases on questions they'll assume a normal distribution, it's going to have a bell curve. And when we do that, we also know that the standard deviation 1, 2, and 3 standard deviation is about 68 for 1, 95 for 2, and 3 is 99%. This also talked about confidence levels when we talk about standard deviations, or what the expected value is. That's where we want to land at. This was in some of the older books, but I think it's a good representation to help you understand what these figures might look like when they're symmetrical, and where the values might be. And so a normal distribution, so mean, median, and mode, it's all pretty much right in the middle in this line. When we look at figure B here, the mean and the median is going to be in the central line, but the mode, the value of the mode might be spread out a little bit more just because it's a wider curve. It's not quite the bell curve that we see here. An inverted one, the mean and the median can still be in the middle. And it's not showing the mode on there. We'll talk a little bit more about skewed. And in this case, if we see the top of the curve typically is always going to represent the mode. And so whether it skews right or left, you're always going to have the mode at the top. And then typically the median is going to be in the middle, just like it would normally. And then the mean might be more, again, of the average, it'll be on the tail side of that. And when we talk about claims, what type of curve would we like to see? What type of skewness? This is skewed left, meaning the tail is on the left-hand side, and skewed right. And what this, if I was to say what type of claims I'd want to see, I'd rather see a skewed right, because what we're seeing in here is we have a lot of small claims, dollar amounts, right? Whereas here we have less claims at a high dollar amount. So that's the idea of, at least from a risk standpoint, or looking at from a data standpoint. So here's some basic questions. So when forecasting losses on the basis of a probability distribution of past losses, Risk management professionals generally prefer probability distributions that have large standard deviations rather than small ones, right? Explain why you agree or disagree with the above quotation. And the second one is to draw two bell-shaped probability distributions and indicate which has the smaller standard deviation, right? Well, you of course already have the slide deck, so you know the answers to these. So we basically disagree with the question, right? Because a large standard deviation means that losses are spread over a wider range, making exact forecast more difficult, right? So going back to the question, oops, explain why you disagree with the above quotation, that we prefer probability distributions that have large standard deviations rather than small ones, right? That again, we'd have a small, to spread over a smaller or larger area, that's why we'd pick that one. On 2, curve A has a smaller standard deviation, right? So the standard deviation, because it's, if you look at how far it goes, whereas this one is spread out much further, it's much harder to tell what's going on. Our losses are spread. And from a loss standpoint, the challenge is where do we focus our attention? Where do we get the most bang for our buck when we start looking at those losses? So this is going back to those standard distribution slide, right, or normal distribution. And we have our standard deviation. We looked at the hours. Remember we said, and again, it's only focusing on the replacement, the lower hours. So expected is 5,000. One standard deviation is 4,700. We have 4,400 hours. That's 2 standard, and at 3 standard deviations, it's 4,100 hours. And this is the years before changing. So how often would we need to change? And to determine that, we divide A, so 5,000 hours divided by 2,000 hours of what's being used, and that will give us an idea of when we would actually change it, and saying we need to change it every 2.5 hours. If we go 3 standard deviations, we're going to change it every 2 years, right, instead of 2.5 years. And the cost per element, if you look at what's going to cost us if we do that, right, we can come up with some numbers. And the whole idea of this is to kind of put the probability distributions of what's the cost, right, to basically go to have less failure. So in this case, where it's expected, we'd probably be spending $96,000 either way. So in this case, we're spending about an extra $20,000. And by doing that, the probability drops down to 0.13% that we're going to have failure. Now, is that 20,000 worth that less failure? I think in this case, absolutely. If you think about a jet engine, if you look at failure rates of what the deviation, that's how all these things are calculated. What the PM schedules will be are based upon what the anticipated failure rates are. So it's really just using this basic technique to do that. So you're not going to have to do these calculations. The main thing is it's important to understand what's the application? How does it work? Why is it important with risk management to basically be able to do these type of calculations or the risk analysis and the probability distributions to be able to make effective decisions, right? And you see the cost aspect associated now also with the loss potential. So we also talk about regression analysis. So now, besides going into the the distribution, now we're normal distribution, we're going to talk about regression analysis. And this is more really what actuaries tend to do. And also, again, assumes that that change in the dependent variable is constant, right? That we're not going to have a whole lot of variation for each unit of change in the independent variable. So if we look at hours and things like that. And then there's the equation that's provided as part of this. And it kind of gives you an idea of what that might look like on there. So again, just to understand what regression analysis is. So the example that they give in the textbook is the relationship of losses to exposure, or tons of output, right? In this case, it's a calculator. You're not going to need to really calculate on here, but this gives you an idea of that how they use this type of information. So in year 1, the annual number of losses is they expect about 4, or this is the data that they have, and that was based upon 35, or in this case, tons of output times 100,000, but 30. Let's just say 35 tons, right? Year 2, they still have 4 losses, but they had 60 tons of output, Year 3, they had 5 losses, but they had 72 tons of output. In year 4, they had another loss and they had about 95 tons of output. And then you can actually say, okay, on average, how many losses are we going to have over that period of time? Or let's look and see if there's a relationship when we do regression analysis. The idea being on this, just like if you think about, let's use injuries in workers, the idea is that, or Bureau of Labor Statistics for those on the safety side, the more hours that we have people working, or more people working in general, we're expecting that we're going to probably have more injury. So if I say that we're going to have 3 injuries for every 100 full-time employees, right? If I have 200 employees now working, if I double my employment, I'm expecting those 3 injuries. I'm probably going to see 6 injuries for that year, which it basically equates to the same thing. And that's where that analysis comes from. So here, this is basically where it's plotted on a chart. And this is where you kind of get the linear depiction of it based upon the output, right? We did whatever that first year was about 35 tons, and that was with 4 losses. Then we had 4 losses again, kind of a little bit below, and then, but you can see how this line developed. The idea is if we keep on doing this, we're always going to have that. Now, the downside of this is, let's say that we say we're going to have 0 output, right? And we replace that as the variable. Well, it's still going to say that we're going to have, we'd still have 3.5 losses, right? So sometimes this regression analysis can only go so far, and it's important to understand how that actually does work. So if you're going to use regression analysis as a tool, these are some of the key things that they talk about in the book, and this is where I would expect to see a question. Forecasts should only be accepted if underlying assumptions are valid, right? If the data doesn't look right, if the numbers don't seem out of whack or there's outliers, that's where you have to take another look at the data. Results must be interpreted within reason. That goes back to that 0, right? If you have no output, would you still expect it to have 3.5 losses? Scarcity of data can affect results, which makes forecasting difficult. So if you're a new business and you don't have a whole lot of data, or no data, then they're going to have to rely upon industry standards of what you'd expect. So from an underwriting standpoint, that's where this becomes important as well. In curvilinear regression should also be considered to measure relationship between independent and dependent variables. Wouldn't worry about that one on the exam as far as discussion-wise. So that's basically on regression. So we kind of gone through this fairly quickly with talking about probability, normal distribution, standard deviation, regression now. And now we're going to look at analyzing event consequences. Now, in the book, they really focus on, when we talk about event consequences, is we're going to talk about decision tree analysis and event tree analysis. And it's important to understand the differences, because what they ask for, the objective is to be able to compare the two, right? And what they're used for, to have an understanding of how they would be used in an organization. So decision tree analysis, as it says, analyzes the uncertainties of decision outcomes, right? It can provide both qualitative and quantitative analysis, and starts with a statement of initial decision under consideration. And we'll see some examples of this as we go through. So in this case, the decision we need to make is, are we going to invest in a product or not invest in the product? And then as part of this, if we don't invest, well, we already have our outcome right here, right? It doesn't really have a probability associated with it. And if we invest in the product, we say that we can have a great outcome, a good outcome, or a poor outcome. And this is just numbers they threw in there. The probability of a good outcome is 0.4, or excuse me, a great outcome is 0.4, good outcome is 0.3, and a poor outcome is 0.3 as well. And this is just a way to give a visual depiction of going through a decision tree to say, okay, do we want to make this decision, and what's the possibility of things going wrong as part of that decision, or what's the consequences? And so that's all this is really showing. Event tree analysis, well, it's different. Instead of looking at the decisions, it's analyzing the consequences of accidental events rather than decisions, right? So in this case, an accidental event is defined as the first significant deviation from a normal situation that may lead to an unwanted sequence. And what's different with this, instead of saying we're going to start with the decision, we're going to start with an identification of an accidental event. And that's where you're going to see a question most likely is, which one uses an accidental event as part of the process. So this is much busier, right? The event tree analysis. And so the initiating event, right? This is not a decision. This is the event that we have. It says the whole forms a chemical storage tank over a 10-year period. And you'll see where this probability is coming from here in a moment of where the outcome, but essentially it's a rare event, 0.04, that this event would happen in the first place. And so over a 10 period, and then basically it says false, right? That the idea that there's no leakage, and the idea that we have a whole forms and we won't have any leakage, there's a 20% probability that that would be the case, right? In this case, we say, yep, it did happen, and we can kind of go backwards on here. So actually, I messed up on here. Toxic chemicals leak into the soil. So we have a whole form, toxic chemicals leak into the soil, that's false, so we have no leakage. Toxic chemicals leak into the soil, you say, yep, that does happen. So then what can happen because of that? Leakage barriers do not function, right? What happened, there's a 10% probability that would happen, 90% false. So if that happens, then we say we controlled leakage with no detector. And it basically goes through, if you go through this, it just goes through the various events and says, what's the probability that we'd have a controlled leakage with a detector? About 6.84%. And all it's doing is it's essentially multiplying all these events from occurring and saying, based upon this, this is the probability. The probability in this case, or outcomes, that will have an uncontrolled leakage with no detector, right? So we're saying toxic chemicals leak in the soil is true. We have leakage barriers don't function, which is true. And the leakage detectors do not activate. The possibility of all these dominoes, if we want to call it that, of each one of those aligning is pretty rare. So 0.004% is the probability of this event occurring. And so that's all that this table is showing is on the event tree analysis. You're not going to really have to do calculations, but you want to understand really how is this formed and with the different events, and how does this, how would someone use this type of tool to basically look at the consequences of specific events. As far as where the probability is coming from, most likely these are somewhat subjective. And what's the likelihood of failure of the leakage detectors? They might have some data on that, and they're just going to throw this all in there to come up with some type of probability, decide where they need to focus their attention. I know this is hard to see, but in your textbook, this is going to be on page 7.27, and this is one I probably highlight and spend your time on, because you will have questions, because part of the discussion or the objective is to compare decision tree analysis and event tree analysis, and they've pretty much done this in one sheet for you. Main thing is to understand really the functions and purpose. When you look at some of these, some of the advantages and disadvantages are also areas that I would focus on. But by understanding what the difference is and how they're used at that 50,000 foot level, that's really an important part from the exam standpoint. And then when we talk about analyzing loss exposure, this is the one of the last parts of the chapter here. Right. The analysis step of the risk management process involves considering the 4 dimensions of a loss exposure, right? So when we talk about loss exposure in 4 dimensions, something you're going to have on the exam, again, it's bullet pointed. We're going to talk about loss frequency, right? The number of losses such as fires, auto accidents, or liability claims that occur during a specified period. So typically loss frequency would probably be within a year or a policy period. That's where you'd be looking at that loss frequency, the number of losses within a specific period. Same type of thing for loss severity. It's the dollar amount of a loss for a specific occurrence. And then total dollar losses is the amount of losses for all occurrences during a specified period. So we can have one for that specific event, but then we're also going to have what the total dollar losses for that whole policy period, let's call it. And then timing, the points at which losses occur and loss payments are made. And it talks about the period between loss occurrence and payment can be lengthy. And it really depends on the type of claim. Workers' comp, typically it takes 7 years to close out a work comp claim, or on average, if you look at all of them, whereas typically on general liability claims, within 2 to 3 years, you're probably going to have the payout. Environmental might be 10 years, where you're going to see the timing of the loss between the occurrence and when the loss payment actually occurs on those. And then one of the big issues is data credibility. And so that's the level of confidence that available data are accurate indicators of future losses, right? You need to have a decent amount of data to be able to help determine when we look at loss analysis of what's the likelihood of these type of events occurring. An example I can give is, I typically do loss analysis for both general liability and workers' comp claims in my role that I have now, as well as when I was at Google and with the university. And, you look at, I'll give an example, slip and fall claim. We identified, looking at loss analysis over a period of time, that the food service departments were having over about $7 million worth of losses a year, right? A huge number, and about 4,000 employees. And so we were able to identify that, and then by providing, in this case, slip-resistant shoes, over a period of time, we saw those dramatic reductions in those slip and falls occurring. So we focused on the frequency and the severity of those losses, and then we're able to, at least that's how we were making a decision to implement some of the changes that we did. So as mentioned, loss frequency, number of losses occurring during a specific period, loss severity. Really the purpose is to determine how serious a loss might be, right? So someone can slip and fall and bruise their hip, or someone can slip and fall and break their hip, right? The frequency, obviously that can still occur. We can have a frequency of the slip and fall, but the severity of the loss can be quite different depending on the age of the person, all those type of things. So we try to get an idea of how bad that could be, right? And so there's also the idea of maximum possible loss. And that's a total value exposed to loss at any one location or from any one event. So total maximum loss, if you have a fleet of vehicles, what's the possibility of losing all those vehicles? All those things become part of that maximum possible loss. So skewness. Now this is the example that they give when we start looking at loss analysis now, right? We're going to take a look at some of the data here. In this case, the number of hurricanes making landfall in Florida during one hurricane season. So our time period is 1 year, right? So we have a time frame. And this is the past history that they've seen, and the prediction. So the likelihood of 0 is about 30%. We saw this earlier, right? And if we look at this histogram, and then they kind of do this, the trend line here, right? We see 1 is about 35%. This is the most common. So this is the median and the mode are about 1, but the mean is about 1.2. So the central tendency is most likely one hurricane a year, about 30% of the time will reach landfall. 2 reaching landfall is a little bit less, and we can kind of see when we get to 4 and 5, it's not going to happen that often. So this is positively skewed or right skewed, right? And when we look at this, this is the type of thing we'd rather see is we'd rather have less, not that many losses on this side, and when it happening more often, or excuse me, the cost of these, it doesn't talk about cost, but the number of events occurring, not happening that often, so that's why we're seeing over here. Whereas if it's happening a lot, it's not gonna happen. That's why we get that skewness. So from an insurance standpoint, this is the type of thing we'd rather see these large catastrophic or even large claims not occur that often. So when we talk about the frequency and severity, there's in the textbook they talk about the Prouty approach, and really when we look at the data, it's when do we either want to transfer, retain, risk, and that. We're going to talk about that more in the next chapter here. But the idea is we talked about severity, right? The amount of loss, slight, significant to severe. And we talk about frequency, almost never happens, right? Nil, slight, moderate, and definite. If we see that there's it's going to almost never happen and the loss severity is high, right? Typically, we want to transfer the risk or reduce or prevent it if we can. So on these type of events, what this chart is basically saying is when we see that it almost never happens or doesn't happen that often, this is typically we want to transfer. If it's always going to happen and it has a high severity, we probably want to avoid doing those type of activities or get out of that business essentially. And same thing for significant here. That's all this is really showing is you'll probably have a question saying what type of events or what type of losses where would you want to transfer risk. So that's why this figure is important, is to really have an idea of that when the almost nil and slight, you really want to retain risk on things that the severity is really low on type of things. You want to retain as much as possible, even if they happen all the time, because you'll know the history, right? That you can retain the risk and try to prevent them, but you'll have enough loss history to be able to pay for the claims, or at least know that you'll have enough money to pay for the claims, whereas things over in this area are much harder to predict. And this is where it talks about extremely unlikely. This is basically just talking about the chart. And when there's 3 categories of loss severity, slight, organization can readily retain each loss exposure. When it's significant, cannot retain the loss exposure. Some part of it must be financed, and finally severe. That's really when you finance. If you have a severe loss severity, that's when you want to transfer the risk or buy insurance. Now, this is just showing a claim distribution and how this works. You're not necessarily going to have to do this calculation, but they might have some data that shows on here, and you just have to be able to understand what this is, what they're trying to show, and explain what's happening with it, right? So, and all they're doing in here is just taking the number of losses and what the probability is, and basically looking at all possible outcomes. And so that's why you see the dollar loss amount being 500, and the possible outcomes, the way they can do that is having 2 losses, basically at $250 a piece, or they can have 1 loss at this one. And so they're just multiplying all these numbers up to come up with a distribution on here, and that's where they're coming up with these numbers. Again, not something you have to do on the exam, but they just want to show how this would be used essentially for distribution aspect. And so now when we look at the data, this is what they basically come up with, right? Total losses calculated by multiplying loss frequency by severity, and we come up with an expected value, in this case of 4.9. Expected total dollar losses 4.9 times 383, which is where it's expected. That's where we're going to have 1,800. Worst case dollar losses that we're going to have 9. I'm not sure why they wasn't 10 on here, but at a total, if you add them all up, we're going to see, or excuse me, at the 883 with the probability. Our worst case is that we'll spend about $8,000, or we'll have $8,000 in losses. And this is just really simplified actuarial equation of looking at how they would look at some of the loss figures. Talking about timing and data credibility. So mentioned earlier, timing requires considering when losses will occur, but also the likely timing of payments made for those losses. And where this comes into play is looking at reserves and, or kind of like the reserves for a claim and how long you're going to have to hold those and account for that as a liability on the books. Now I put something in here, this is not something on the exam, but I put must consider when reserves are held and counted for accounting and tax reasons. So for organizations that are self-insured, they can't claim that expense as a tax deduction or a business expense. Those the dollars that are held in reserve to pay for claims. Only what's paid out. Whereas if you buy insurance, that whole amount you paid the insurance for is considered a business expense and can be considered a tax deductible or a business expense to reduce that as a liability. So that's just a side note of why when organizations self-insure, some of the things that they have to consider as part of that. So payout schedules. So typically when we talk about payout schedules and where the timing comes into play is auto and property losses have quick payouts, typically 12 months or less, right? You damaged, you totaled the car, you got it fixed, we know what it's worth, and we're gonna try to get that paid and done with as quickly as possible. Workers' compensation and liability claims have a much longer payouts, typically 3 years or more for indemnity claims. Environmental claims can be 10 plus years, right? Exxon Valdez, some of those other things, they can be years and years where they're tied up into litigation as part of that. And then data credibility. Again, when we talk about data credibility, we're referring to the level of confidence that available data can accurately indicate future losses. 2 issues that may indicate poor data can be the age of the data. And now typically when we talk about age, it's not so much the older data, it's actually the newer data, right? That it's not matured, it hasn't developed. And an example I usually try to give is And we'll talk about IBNR, incurred but not reported in ARM 56. But typically your first year data is so green that if someone that has a back injury and it's valued at $10,000, probably, well, 18 months later, there's the loss development factor. It's probably made two to three times more. So what was valued at 10 is probably going to grow to about $30,000. And that's why the older the data, the better, the more mature or has development in it. That makes it much more credible to be able to use. That's where actuaries typically will not use the most recent loss year data. They'll take the 4 years of data, they'll say, but exclude the most recent when they do their analysis. The other issue is data does not represent actual losses or estimate of losses. So one of the challenges, example of that would be medical malpractice data, or even in terms of, I'd say, general liability, depending on the type of claim that might be had, is that a lot of times you don't know what the outcome is going to be, especially if it's where it's highly litigated and environmental. And so you're basically, the reserves are usually quite high, assuming worst case scenario. They're setting aside money. And so when you use that to do analysis, it may skew the results a little bit. So, and also you just don't see a lot of claims typically for an organization in some of those areas. And so it's much harder to predict in some cases. All right. So after all that fun probability and distribution, we get to go through the short little segment on risk treatment. So risk treatment, this is a nice, easy 10 pages in the chapter with 2 learning objectives. Describe the risk treatment process and risk treatment techniques, and describe risk financing and it's important to organizations. So risk treatment, what are we talking about? So available risk treatment techniques. You can avoid the risk, right? And we saw that on the Prouty chart as well. You can avoid the risk, which basically means not taking on that activity. In some ways, you can say you're going to contract it out. You're not going to do that actual work because it is too high risk for the organization. You can modify the likelihood and or impact of the risk, which is basically when we talk about risk control, right? We're going to focus on loss prevention and loss reduction techniques, and those will be discussed more in ARM 55. We can transfer the risk, which is essentially we're going to buy insurance, but that transferring the risk can also be done through contractual risk transfer. We can retain the risk, which basically means we're going to self-insure. Again, that's part of a risk financing technique. And lastly, you can exploit the risk. Now, exploit the risk didn't used to be on here about 15 years ago, but with enterprise risk, the idea is that there might be some techniques of how can you leverage a situation to actually make more money or have a better outcome. So that's where that exploit the risk comes from. So the most common risk control technique is risk control with risk transfer or retention, the most common, right? So the idea is that we're going to try to reduce losses as best we can through having mitigations and providing slippery shoes or all those type of things, from risk control, sprinklers to prevent property losses. But we're also going to buy a little bit of insurance, and we're also going to retain as much risk. The ideal state for almost any organization is to retain as much risk as possible, right? You want to, be able to determine your losses, be able to control your own destiny. And if you can retain as much risk, then you only buy insurance, you only transfer that portion, which is really catastrophic risk. Because when you buy insurance, all you're really doing is, you be able to sleep at night, that you'll have financing to be able to pay for a loss. But what you're also doing, if you have no losses and you're doing a great job with your risk control, you're basically giving money to the insurance company to make investments off of, and they make that money. So the idea is if you can use your own dollars to pay for actual losses, and you can predict that through the analysis that we just did in the last chapter, you're going to be in a much better spot. So this is basically the graphical kind of figure that we just talked about. Avoid the risk, modify the likelihood and or impact, transfer, retain, or exploit the risk. So when we talk about risk treatments, loss prevention, what is that? A risk control technique that reduces the frequency of a particular loss, right? So prevention focuses on frequency, loss reduction focuses on severity, focuses on the cost. Typically, you might hear the term, if you've done this for a while, frequency drives severity, right? If you don't have an event If you don't have a loss, then you don't have any severity associated with it. So the goal is, if we can control frequency, you're automatically going to control the severity, and that's where the loss reduction comes in. You will most likely have a question that says a statement like this, and this describes, which one has more of an effect on frequency or something like that, or severity. Again, you're going to have something like that. Part of the reason why is that this is only 10 pages. They have to ask some questions out of this, and there's not that much stuff that they can really ask questions on, because it's a fairly simple chapter. So I would expect a question dealing with the difference between loss prevention or reduction, or where they focus on. Examples of loss reduction would be sprinklers. I mentioned before, a sprinkler doesn't prevent a fire, but it can reduce the severity of the amount of damage that the fire may be able to do. Whereas loss prevention, if you're trying to prevent slip and falls, I use the slip-resistant shoes. That's actually preventing, most likely, the frequency of the slip and fall, so it's not occurring in the first place. But then also, it may help with the severity as well. So it can have both of those effects. But it's primarily a loss prevention, since it focuses on frequency. Retention. Retention is a risk financing technique that involves assumption of risk in which gains and losses are retained within the organization, right? When you think of retaining, basically you're self-insuring, or you're having a really high deductible type program. Those are all ways that you can actually retain risk, right? And it just means that you're going to pay for those losses. You're going to retain them within the organization in doing that. Risk financing is a conscious act or decision not to act that generates the funds to offset the variability in cash flows that may occur as outcome of risk, right? So risk financing, when we think about that, is actually, it says to act or not to act that generates the funds to offset the variability of cash flows. So risk financing does include buying insurance, but also retains a risk, because you're actually setting aside dollars to pay for some of those losses. So when we talk about risk financing, it's not just buying the insurance. It can also mean retaining the risk as well. So when we talk about transferring, though, that is typically buying insurance. In the context of risk management, it's a technique by which the financial responsibility for the losses and variability in cash flows is shifted to another party. The main thing when we talk about risk financing, and again, the key word is financing, is that all that this does when we buy insurance is it pays the financial aspect of the loss. It does not do anything for the operations, the lost revenue, all those type of things. It's going to pay for the equipment that was damaged or the employee that was injured. So you're not paying additional cost outside of that. So again, when we talk about financing, it's really about the dollars. So that's why there's such a huge focus on risk management, or ERM now, is how can we really not just finance risk, how do we prevent these things from really occurring, not only on hazard risk, but reputational, operational, strategic, all those other types of risks as well. And this is just a visual depiction of the same thing. Transfer the risk, retain the risk. These are both elements of risk financing, right? So we talked about risk transfer. So we can transfer risk. And one way we've talked about, which most people are familiar with, is insurance, right? It's a funded risk transfer. We're paying an insurance company. They're going to take that risk on. They'll basically doing that. And by accepting, as it says, by accepting premium, the insurer agrees to pay for all of the organization's losses that are covered by the insurance contract. And a lot of times with insurance, they most likely will provide some other services, claims handling, loss control, some of those other types of things for the insurance, but they're primarily there to basically pay for the claims. Contract. You can also transfer risk through contract, which is a non-insurance element. So when we do that, we're transferring the financial consequences of an event to a party other than the insurer, deal solely with assigning responsibility for an event arising out of a particular relationship or activity. And essentially, these are waivers and hold harmless agreements, right? Most of the work that I do now with our public entities, a large portion of that is spent on contractual risk transfer, right? If you're having a vendor perform a service, you want to make sure they hold harmless, that they're going to indemnify you if there was type of event, and also that they have the proper insurance to cover you in the event of that. And it's probably, I think most organizations probably spend a lot of time on contractual risk transfer, more so than they really do on the insurance side anymore, because it's a way to it's an inexpensive way because you're not having to pay for it to basically transfer risk to the other organization. Hedging, in 56, we'll talk more about all these things, but it's futures contracts to offset potential losses and may prevent, but it also may prevent large gains as well, but it provides stability. Best example I always give is Southwest or the airlines in general, basically buying futures contracts for fuel. And what that does is they know exactly what they're going to be paying for the next couple of years on their jet fuel. When prices were going up, Southwest was able to pay a certain price, they hedged properly. But then there's also the idea that even when they bet wrong and they may lose some money or they're not going to get as much profit, but at least they have stability. And really when we talk about risk management or what risk is, it's the effect of uncertainty on objectives, right? If we think about that, by having that hedge and that stability, we're basically reducing the uncertainty of what our profit's going to be because we know based upon those contracts being in place. Risk retention. So consider a form of risk financing when there's an internal fund established to pay for losses, often preferred technique. And it's a last resort technique when event cannot be insured. So what does that all mean, what I just said there, right? So when we retain risk, it's one thing you want to do it on purpose, right? So as we talk about consideration, it talks about planned retention. It's a deliberate assumption of risk that's been identified. So if we're going to retain the risk, we know that on average, we spend $1 million a year on workers' comp, and we're going to set aside money, essentially almost like an escrow account, to pay for those losses. All right, that would be a planned retention. So you're going to have an internal fund. It is the preferred technique because we're not paying an insurance company excess dollars or premium risk on top of that. So we can invest those dollars while they're sitting in escrow to basically gain interest. So it's going to be a much better technique for us. But as I mentioned, last resort technique when event cannot be insured. There might be certain things where you just can't buy insurance for. And so when you can't do that and you can't avoid the risk, you're going to have to retain it. So that's why it's also considered a last resort technique, is that there just might not be coverage or the coverage is too expensive. And so the decision is made that you're not going to buy insurance and you'll just retain the risk. So some of the considerations I mentioned already: planned retention, which is deliberate assumption of risk that has been identified. We're going to hold dollars back. Unplanned retention, that the risk was unknown or not properly analyzed. We didn't realize that we had this liability or this exposure, and so there might not be money set aside, and that would be an unplanned retention in which there's no insurance as well. Complete or partial. So how much of a cost of a loss is retained by the organization? So retention kind of goes back to what we call SIR within the public entity, self-insured retention, or you can say you have a high deductible, right? You might have a high deductible program, and that's again where you go to that partial versus the self-insured retention. And then you can also have funded or unfunded, right? A funded account can earn interest, serves as an escrow account. Unfunded is a pay-as-you-go, and monies would come out of operation budget to pay for losses, right? And so most sophisticated organizations, they're going to fund, they're going to have a planned retention, they're going to fund it to make sure there's money's available for that. All right, so with that, we've actually gone through Chapter 8, and we'll be going on ARM 56, much more detail on all the risk financing aspects. So this is just basically a basic overview to understand how risk financing and risk treatment works as part of that. So with that, we will conclude tonight. Thanks everyone for attending. Only 4 more classes left. Look forward to your questions, and we'll see you again next week. Thanks.